Before we dive in, it's crucial to understand that this presentation is for educational and informational purposes only. I am not a licensed insurance agent, attorney, or financial advisor, and this video does not constitute legal or financial advice. Every accident and every insurance policy is unique. You should always consult with a qualified professional and review your own policy documents before making any decisions. The sound is what you remember first. The horrifying screech of tires that seems to last an eternity, followed by the sickening, explosive crunch of metal and glass. Your heart hammers against your ribs, adrenaline floods your system, and for a split second the world goes silent. You check yourself. You check your passengers. Everyone's okay. The relief is so powerful it almost makes you dizzy. But then you get out of the car, and you see it. The crumpled fender, the shattered headlight, the deep gash running down the side of what was, just moments ago, your perfectly fine car. And that's when the real panic sets in. Because now, you have to use your car insurance. That thing you pay for month after month, year after year. That complex document filled with jargon you've never really understood. It's about to be put to the ultimate test. And the scary truth is, for the vast majority of drivers on the road today, they have absolutely no idea what's about to happen next. They think they're covered. They think they're protected. But they don't understand the rules of the game they're about to be forced to play. This is not just another boring video explaining deductibles and premiums. This is a survival guide. By the time you finish watching, you will have a step-by-step, insider's playbook for navigating the chaotic, confusing, and often frustrating world of an auto insurance claim. You will know exactly what to do, who to call, what to say, and more importantly, what not to say, to ensure that the company you pay to protect you actually does its job. We are going to demystify the entire process, from the moment of impact to the moment you get that check, so you can take control and protect yourself from costly mistakes. So let's go back to the scene. You're standing on the side of the road, looking at the damage. Your mind is racing. What is the absolute first thing you should do? It's not calling your insurance company. It's not even exchanging information with the other driver yet. The first, non-negotiable step is to ensure safety and document the official record. First, if anyone is even remotely injured, or if the cars are not drivable, you call 911 immediately. Get police and medical help on the way. Even in a minor fender bender where everyone feels fine, getting a police report is one of the single most important things you can do. Why? Because a police report is an impartial, third-party account of the accident. It establishes the date, the time, the location, the parties involved, and often includes the officer's initial assessment of what happened and who might be at fault. Later, when it's your word against the other drivers, this official document can be the bedrock of your claim. Without it, the other driver could change their story, claim injuries they didn't have, or even deny being there at all. So get the police there. It is your right. While you're waiting for them to arrive, you become a detective. Your smartphone is now the most important tool you own. You are going to document everything. And I don't mean one or two quick pictures of the dent. I mean you are going to create a comprehensive photographic record of the entire scene. Start wide. Take pictures of the entire intersection or stretch of road, showing the position of the cars, traffic signs, skid marks, and weather conditions. Then move closer. Photograph the damage to both vehicles from every conceivable angle, close-ups, medium shots, shots that show the point of impact. Get down low, get up high. Open the car door and photograph the VIN number on the dashboard or the sticker inside the door jamb of the other car. This proves which vehicle was actually involved. Then you take a picture of the other driver's license, their insurance card, and their license plate. Be polite but firm. For our insurance records, can I please get a photo of your license and insurance card? This is standard procedure. Don't just jot it down on a napkin that you're going to lose. A photo is undeniable proof. If there are witnesses, people who stop to help, get their name and phone number. A witness statement can be incredibly powerful. You are building a fortress of evidence, piece by piece, before anyone has a chance to forget the details or change their story. Okay, the police have come and gone, you have your mountain of photographic evidence. Now and only now is it time to make the call. You need to report the claim. This is where people make their first big mistake. They don't know who to call or what to say. Your insurance card has a toll-free number on it, usually for a national call center. This is your primary way to FNOL, first notice of loss. That's the industry term. You're officially putting the insurance company on notice that an event has occurred. When you make this call, your goal is to be factual, concise, and calm. You are not there to argue your case, to vent your anger, or to speculate about who was at fault. You are there to report the facts. You will provide your name, your policy number, and the date and time of the accident. You will provide the other driver's information that you so brilliantly collected. You will give them the police report number. And that's it. The person on the other end of the line will ask, "So what happened?" This is a critical moment. Do not say, "I'm so sorry, it was all my fault." Do not say, "I think I looked away for a second." You never ever admit fault. Even if you think you were 100% to blame, you are not a professional accident investigator. You don't know if the other driver was speeding or texting, or if their brakes were faulty. You simply state the basic, undeniable facts. I was proceeding north on Main Street. The other vehicle entered the intersection and our vehicles collided. Let the facts and the police report speak for themselves. They might also ask if you are injured. Your answer should always be cautious. Even if you feel fine, adrenaline can mask injuries that show up hours or even days later. A safe and honest answer is, "I'm not sure yet. I'm going to get checked out to be safe." This keeps your options open if you wake up tomorrow with severe neck pain. Once you hang up that phone, a process is set in motion. Your claim is assigned a number, and more importantly, it's assigned to a person, an insurance adjuster. This person is now the gatekeeper to your claim. Their job is to investigate the accident, determine who is at fault, and decide how much the insurance company is going to pay. And it's vital you understand their role. They are not your friend. They are not your advocate. They are a trained employee of a for-profit corporation whose primary fiduciary duty is to their shareholders, not to you. Their job is to resolve your claim efficiently and for the lowest possible cost that is legally and contractually required. They can be friendly, they can be helpful, but their goals are not perfectly aligned with your goals. Your goal is to be made whole. Their goal is to close the file. Understanding this dynamic is the key to everything that comes next. So let's break down what closing the file actually means. To you, it means your car is fixed, your medical bills are paid, and your life is back to normal. To the insurance company, closing the file is an accounting term. It means the claim is resolved and no more money is going out the door. The single most important variable in that equation is how much money goes out the door. Their goal is to make that number as small as legally possible. And your first interaction with them, that first phone call, is their first and best opportunity to start shrinking that number. This is where most people make their biggest mistake. The crash just happened. You're shaken, maybe a little sore, your adrenaline is still pumping. You know you need to call the insurance company, so you do. You get a friendly, professional-sounding person on the line. They're sympathetic. They say things like, "I'm so sorry this happened to you, we're here to help make this right." And then they say the 9 most dangerous words in the insurance world. Do you mind if I record this call? Your instinct, your desire to be helpful and get this over with, is to say, "Sure, no problem." You have just fallen into the single biggest trap in the entire claims process. That recorded statement is not for your benefit. It is not a tool to help you. It is a tool for the insurance company to lock you into a story, your story, before you have all the facts. They want to get your version of events on tape right now while you're still confused, flustered, and possibly not even aware of your own injuries. Why? Because memories are messy right after a traumatic event. You might misstate a detail. You might guess at a speed. You might say, "I think I saw the light turn yellow," when the police report later confirms it was green. Later on, if your story solidifies or you recall a key detail, they will pull out that recording and say, "But that's not what you said on the day of the accident. Why is your story changing?" They use it to question your credibility. The most insidious part is how they use it for injuries. The adjuster will ask, "So, how are you feeling right now?" And you, trying to be tough or just not wanting to complain, will say, "I'm okay, a little shaken up, but I'm fine." 2 weeks later, when the adrenaline has worn off and you realize your back is in agony and you can't turn your neck, your doctor diagnoses you with severe whiplash. When you file the medical claim, the insurance company will come back and say, "But on the day of the accident, you stated on a recorded line that you were fine." They will use your own words, spoken in a moment of shock, to argue that your injuries must not be from the accident. So what do? Simple, but it takes discipline. When they ask to record the statement, you politely but firmly decline. You can say something like this: "I'm not comfortable giving a recorded statement at this time. I am still processing the event and I don't have all the information in front of me yet, like the police report. I am happy to provide you with the basic, factual information needed to open the claim, my name, policy number, the date and location of the incident, and the other driver's information. I will provide a full written statement once I have had a chance to gather all the facts. That's it. Be a broken record. They will push. They might say it's standard procedure, or that it speeds up the process. It does speed up the process for them. It speeds up their ability to find a reason to deny or devalue your claim. Stand your ground. There is no law that requires you to give an immediate recorded statement over the phone. Now, there is a critical distinction to be made here. You have a duty to cooperate with your own insurance company. It's in your policy. If you refuse to cooperate, they can deny your claim. But cooperation does not mean giving them a recorded statement on their terms, moments after a crash. Providing the basic facts is cooperation. Agreeing to a vehicle inspection is cooperation. Sending them the police report is cooperation. Providing a written statement after you've had time to think and review the facts is cooperation. An on-the-spot, recorded interrogation is not a requirement. But what about the other driver's insurance company? This is where the rule is even simpler. You have zero, and I mean absolutely zero, obligation to speak with the other driver's insurance adjuster in a recorded statement. None. Their job, their sole purpose for calling you, is to find a way to blame you for the accident. Even if their driver ran a red light and T-boned you, the adjuster will be fishing for any little thing they can use. Did you see him coming? Could you have swerved? Were you distracted for even a second? They will twist your words to assign you 10% or 20% of the fault, which in many states allows them to reduce what they have to pay you by that same percentage. When the other driver's insurance company calls, and they will call, you say this: all communication regarding this claim should be directed to my insurance company. Here is my claim number and my adjuster's contact information. I will not be providing any statement to you. And then you hang up. Feels rude. Feels confrontational. But you are not dealing with a customer service representative. You are dealing with a financial adversary. The foundation of your entire claim, the document that you should be referencing, is the police report. This is the closest thing to an objective account of what happened. An officer responded to the scene, they observed the evidence, they took measurements, they spoke to witnesses, and they compiled a report. This report is your shield. Before you give any detailed statement, even a written one to your own company, you need to get a copy of that police report. It will have the official diagram of the scene, witness statements, and most importantly, the officer's determination of who was at fault. You can typically get a copy from the local police department or sheriff's office that responded to the call, usually a few days after the accident. It costs a few dollars, and it is the best money you will ever spend on your claim. Your memory is fallible. The report is a fixed record. When you have this document, you can write your statement to your insurer with confidence, based on the documented facts, not your shaken-up memory. By controlling that first point of contact, by refusing the recorded statement and waiting for the police report, you have fundamentally shifted the power dynamic. You've taken away their primary tool for picking apart your story and devaluing your claim. You've moved from being a flustered victim to a prepared, informed claimant. You've successfully navigated the treacherous first call. You haven't said anything to hurt your case. But now the adjuster has a new task: to assess the damage to your vehicle. And they have a whole system of preferred vendors and quick estimates designed to, once again, close the file as cheaply as possible. Getting your car fixed correctly is the next battleground, and it starts the moment they say, "Don't worry, just take it to one of our approved network shops, it will be much faster." That phrase, "our approved network shop," it sounds so helpful, so reassuring, but it's one of the most masterful and potentially dangerous bits of psychological framing in the entire insurance process. What they're really saying is, please take your car to a shop that works for us, not for you. These are called direct repair program shops, or DRPs. And you need to understand the relationship. These body shops have a contract with the insurance company. In exchange for the insurer sending them a constant, high-volume stream of damaged cars, your car, the shop gives the insurance company some major concessions. They agree to lower labor rates. They agree to faster repair times, which can sometimes mean cutting corners. And most critically, they often agree to use the cheapest parts possible to get the job done. The DRP shop's primary customer isn't you. It's the insurance company that feeds them. Their incentive is to keep the insurer happy, so the referrals keep coming. Your incentive, getting your car repaired perfectly and safely, is secondary. This is a massive conflict of interest, and your car is caught right in the middle. So when the adjuster says it will be faster, What they mean is the shop won't waste time fighting them for the proper procedures or parts. When they say it's easier, they mean it's easier for them because they control the entire process. They've turned the repair shop, which should be your expert advocate, into just another arm of their cost-cutting machine. Here is one of the most important things you will ever learn about car insurance. In almost every state in America, you have the absolute legal right to have your vehicle repaired at any shop of your choosing. Let me repeat that. It is your car, your choice. They cannot legally force you to use one of their network shops. They can try to persuade you, they can make it sound inconvenient to go anywhere else, they might even say they won't guarantee the repairs if you go to an independent shop. Don't fall for it. A reputable independent collision repair shop will offer its own lifetime warranty on their workmanship. The insurer's guarantee is often just a marketing gimmick to steer you back to their DRPs. Choosing an independent, high-quality body shop is the single most important decision you will make in this entire process. You need an expert on your side, someone whose only loyalty is to you and the structural integrity of your vehicle. A great shop will work directly with the insurer on your behalf. They become your bulldog, your advocate. They know what the car needs, they know how to document it, and they know how to fight the adjuster for it. So how do you find one? Don't just Google body shop. Look for shops that are certified by your car's manufacturer. A Honda certified shop, a Ford certified shop, a BMW certified shop. These certifications are not easy to get. They require extensive training, expensive, specialized equipment, and a commitment to using the manufacturer's exact repair procedures. This is your best sign that a shop prioritizes quality over volume. Once you've chosen your advocate, your independent, certified shop, the next great battle begins. The battle of the parts. The insurance company's initial estimate, the one the adjuster wrote in 15 minutes in your driveway, will almost certainly specify the use of non-original parts. They'll use a few different acronyms to disguise it. You'll see parts labeled as aftermarket, quality replacement, or LKQ. Let's break down what these mean. Aftermarket parts are knockoffs. They're copycat parts made by a third-party company. They've been reverse engineered to look like the original, but they are not made by your car's manufacturer. They may be made with cheaper materials, to different tolerances, and they often don't fit correctly. A body shop might have to bend or force an aftermarket fender into place, breaking the corrosion-resistant coatings and creating a future rust spot. More importantly, these parts have not been crash-tested as part of your car's integrated safety system. That new bumper or fender might look fine, but will it absorb and distribute crash energy the same way the original did? Will it trigger your airbags at the right millisecond? The answer is a terrifying maybe. LKQ stands for like, kind, and quality. This is a fancy term for a used part from a junkyard. They'll call it a recycled part. Now, sometimes an LKQ part can be a good option if it's a used OEM part from a car with very low mileage that was hit in a different spot. But you're relying on the insurer's word about its quality and history. What you need to fight for are OEM parts, original equipment manufacturer. These are brand new parts made by the same company that built your car on the same assembly lines to the same exact specifications. They fit perfectly, they perform predictably, and they are the only parts proven to maintain the original safety rating of your vehicle. So why doesn't the insurer want to use them? Simple. They're more expensive. An aftermarket fender might be $100 cheaper than an OEM fender. Multiply that by thousands of claims a day, and you're talking about billions of dollars in savings for the insurance industry. Billions of dollars they save by putting inferior, unproven parts on their customers' cars. Your insurance policy is a contract, and that contract almost always contains the phrase that they will restore your vehicle to its pre-loss condition. This is the key. You need to make the argument, and have your chosen body shop make the argument, that copycat aftermarket parts do not restore the car to its pre-loss condition. They compromise the fit, the finish, the resale value, and most critically, the safety. The shop you chose is your critical ally here. They will take the insurance company's lowball estimate, and they will essentially throw it in the trash. They will perform a full teardown of the damaged area, taking things apart to find all the hidden damage the adjuster conveniently missed. That bent bracket behind the bumper, that cracked sensor, that slightly buckled frame rail. All the things that ensure the car is not only cosmetically correct but structurally sound. Then they will write their own estimate. A real estimate, one based on the manufacturer's required repair procedures and specifying the use of OEM parts. This estimate will be significantly higher than the insurer's. And that's okay. That's expected. The shop will submit this new estimate to the insurance company. This is called a supplemental claim, or just a supplement. It's a formal request for additional funds to cover the true scope of the damage. The adjuster will push back. They'll say, "Our estimate is all we're paying for." They'll say, "The aftermarket part is just as good." This is where your advocate shop earns their money. They will get on the phone with the adjuster and go line by line. They'll provide documentation on the manufacturer's position statements, which often forbid the use of aftermarket parts on certain safety systems. They'll show photos of why a part needs to be replaced, not repaired. They will fight for hours, sometimes days, on your behalf. You may have to get involved too. You may need to call the adjuster and calmly, but firmly, state that your contract is for pre-loss condition, and a car with copycat parts is not that. You can state that you're concerned about your family's safety in a vehicle repaired with parts that weren't designed or tested for it. Use the word safety. It's a powerful word that insurers don't like to see documented in claim files. This back and forth can take time. It's a war of attrition. The insurance company is counting on you to give up. They're hoping you'll get tired of waiting and just say, "Fine, use the cheap parts, I just want my car back." Don't do it. Patience here pays off in the long-term value and safety of your vehicle. Eventually, in most cases, the insurer will approve the legitimate repairs. They will pay the supplement. They won't admit defeat, they'll just quietly release the funds because they know your shop is right, and they don't want the liability of forcing an unsafe repair. But as this battle over the cost of repairs rages on, the insurance company is running another set of calculations in the background. They're looking at the rising estimate from your shop, and they're comparing it to a secret number, a hidden value they've placed on your car. If the cost to fix your car properly gets too close to that number, the entire game changes. The fight is no longer about which parts to use. The fight becomes about whether they will fix your car at all. They might decide it's cheaper for them to just take it from you, give you a check, and send your wrecked car to a salvage auction. They're about to declare your car a total loss. And how they calculate that value and what that means for you is the next devastating trap you need to be ready for. The term total loss sounds so final, so absolute. But it's not a statement of fact. It's the beginning of a negotiation. And you need to understand this is a negotiation you are designed to lose. The insurance company holds all the cards. They have the software, they have the adjusters, and they have a very simple singular goal: to close your claim for the lowest possible dollar amount. They are a business. Every dollar they don't pay you is a dollar that goes to their bottom line. So when they say your car is totaled, what they're really saying is, the cost to repair your vehicle is more than it's worth to us. They use a secret formula, a percentage that varies by state and by company. It might be 70%, 80%, sometimes even 100% of the car's value. If your $10,000 car needs $8,000 in repairs, and their threshold is 75%, congratulations, it's totaled. They are now going to write you a check for the car's value and take ownership of your wrecked vehicle. But what is that value? This is the core of the trap. They will offer you something called the actual cash value, or ACV. Those three words are responsible for more frustration, anger, and financial loss than almost any other part of the insurance process. Because actual cash value does not mean what you paid for the car. It does not mean what it will cost to buy a new car. It means what your specific car, with its exact mileage, its specific options, its dings, its scratches, its worn-out floor mats, was worth 1 second before the impact. It's the market value of a used car. And the people who determine that market value work for the insurance company. They use third-party valuation services, companies you've probably never heard of like CCC or Mitchell. These aren't neutral arbiters. They are for-profit corporations whose primary clients are the insurance companies themselves. Their software scours databases of recent vehicle sales to find comparable vehicles in your area. And based on those comps, they generate a report that spits out a number. That number is your ACV. And that number is almost always shockingly low. Let's imagine your car is a 2019 Toyota Camry SE. You bought it used a couple of years ago, you love it, you've kept it in great shape. You just put a brand new set of tires on it last month. An uninsured driver runs a red light and T-bones you. The car's a mess. A week later, the adjuster calls. "Good news," he says, though it never feels like good news. "We've completed the valuation. The actual cash value for your 2019 Camry is $16,450. Your heart sinks. You immediately go on AutoTrader and Cars.com. You can't find a single 2019 Camry SE with similar mileage listed for less than $20,000 at any reputable dealership within 100 miles. Most are closer to $21,000. How on earth did they get to $16,450? You can't replace your car with that. That amount doesn't even come close. You feel helpless. You feel cheated. This is the moment most people just give up. They take the check, sign the papers, and accept a massive financial loss because they don't know they can fight back. But you're not going to do that. Your first move is to say 5 critical words to the adjuster. Please email me the valuation report. Don't argue, don't yell. Just ask for the report. They have to give it to you. This document is your battlefield. It's where you find the evidence to fight their lowball offer. When you get that report, you're going to put on your detective hat. It will list the comparable vehicles they use to determine your car's value. And this is where the games are played. You're going to scrutinize every single one. You look at their first comp. It's a 2019 Camry, alright? But it's a Camry L, the base model. Yours was an SE, the Sport Edition, which has a higher value. The adjuster made a trim adjustment of $200, but the actual market difference is closer to $1,500. Strike one. You look at the second comp. It's an SE model, good. But the report shows it was sold at a dealership 250 miles away, in a rural area where car prices are significantly lower than in your city. The law in most states says they have to use comps in your local market area. Strike two. You look at the third comp, the right model, the right area. But you do a quick search of the vehicle identification number, the VIN, and you find its history report online. This comparable car had a previous accident on its record. Your car had a clean history before this crash. A car with a prior accident is worth significantly less. This is not a valid comparison. Strike three. Now you see how they got to their number. They didn't use truly comparable cars. They cherry-picked the lowest value examples they could find to artificially drive down the value of your vehicle. They also likely made a bunch of condition adjustments. The report might say deduction: upholstery condition $75. Deduction: tire wear $150. They are nickel-and-diming you on normal wear and tear, conveniently ignoring that you have a receipt for $900 for brand new Michelin tires you just bought. So now you fight back with facts. Your job is to build a counter-report. You go to all the major car sales websites. You search for your car's exact year, make, model, and trim level within a 50-mile radius of your home. You find 4 or 5 examples currently for sale at dealerships. You save PDF copies of every single one of those listings, showing the asking price, the mileage, the options, and the VIN. You are building an arsenal of evidence. Next, you assemble your own list of value adds. You have that receipt for the new tires. Scan it. Did you have a factory sunroof? Premium audio system? A tow package? List every single option your car had that might not be on the base model. Anything that adds value. Then you craft a polite, professional, and firm email to the adjuster. You don't accuse them of cheating you. You simply present the facts. You write, "Thank you for sending the valuation report. I've had a chance to review it, and I have some concerns about the comparable vehicles used. The first comp was a lower trim level, the second was outside my geographic market, and the third had a prior accident history, making it an invalid comparison. For your convenience, I have attached listings for 4 2019 Camry SE models with clean histories currently for sale in my local area. As you can see, their average list price is $20,800. Furthermore, the report deducted $150 for tire wear, but my vehicle had brand new tires installed last month, and I have attached the receipt for $900. Based on this market data and the recent upgrades, I believe a more accurate actual cash value is $21,700. I look forward to reviewing a revised offer from you. You have now completely changed the dynamic. You are no longer a victim. You are an informed, prepared negotiator who has called them on their process with undeniable proof. The adjuster now knows you are not going to be a quick, cheap file to close. In almost every case, they will not want to fight this. They will come back with a significantly higher offer. Maybe they don't agree to your exact number, but they might come back at $19,500. You push back again, referencing your comps. They come back at $20,600. That's an increase of over $4,000 from their initial offer. That's $4,000 that was rightfully yours that they were trying to keep. This is not a trick. This is simply holding them accountable to their own rules. They are required to make you whole, to put you back in the position you were in before the crash. And that means giving you enough money to actually go out and buy a truly comparable car. But getting the value right is only half the battle. Once you agree on a number, a whole new set of questions pop up. What about the sales tax you'll have to pay on your replacement car? What about the title and registration fees? The insurance company is supposed to cover those too, but they almost never include it in their offer unless you know exactly what to ask for. And the biggest nightmare of all, what if you still owe money on your totaled car? What happens if that $20,000 settlement isn't enough to pay off the $22,000 loan you still have? That's a terrifying situation called being upside down, and we're going to break down exactly how to navigate that trap next. So you're stuck. The insurance company handed you a check for $20,000, but the bank is still demanding $22,000 for a car that no longer exists. You're on the hook for $2,000 plus your $500 deductible for a pile of scrap metal. You have to keep making monthly payments on a ghost car, all while trying to figure out how to afford a new one to get to work. This isn't just a bad situation. It's a financial nightmare. This gap, this $2,000 black hole, is what's known in the industry as being upside down or having negative equity. And it's shockingly common. Think about it. The moment you drive a new car off the lot, its value plummets. Some estimates say it can lose 10 to 20% of its value in the first year alone. Your car loan, however, doesn't drop that fast. In the beginning of a loan, most of your payment goes towards interest, not the principal amount you borrowed. So you have this race happening. The value of your car is sprinting downhill while your loan balance is just slowly jogging down. For the first few years of your loan, the car's value is almost guaranteed to be losing that race. If you have a total loss during that time, you're trapped. But what if I told you there's a secret weapon for this exact scenario? A specific type of coverage designed to bridge this exact financial chasm. It's called gap insurance. And it's one of the most misunderstood, yet potentially powerful add-ons you can get. GAP stands for Guaranteed Asset Protection. That's a fancy way of saying it protects the asset, your car loan, from the reality of depreciation. It's not insurance for your car. It's insurance for your loan. It exists for one reason and one reason only: to pay off the difference between what your comprehensive or collision coverage pays out, the actual cash value, and the amount you still owe to the bank or finance company. Let's go back to our example. You owe $22,000. The car's actual cash value is determined to be $20,000. You have a $500 collision deductible, so your primary insurance company, like Progressive or Geico, cuts a check for $19,500. That check goes directly to your lender. Now the lender applies that to your $22,000 loan. A little quick math, and you still owe the bank $2,500. This is the gap. If you have gap insurance, this is where it swoops in like a superhero. You file a claim with your gap provider. They verify the numbers with your primary insurer and your lender, and then they cut a check for that remaining $2,500. That check goes straight to the lender, paying off the loan in full. Poof! The debt is gone. You're free. You don't have to spend a single cent more on that wrecked car. You can now focus all your energy and resources on getting a new vehicle, without the ghost of your old car loan haunting your bank account. Some gap policies will even cover your primary deductible, but you have to read the fine print on that. Most just cover the loan gap itself. Now the big question is, do you actually need it? The answer is a hard maybe. It depends entirely on your financial situation when you buy the car. You almost certainly need gap insurance if you did any of the following. First, you made a small down payment or no down payment at all. The rule of thumb is 20%. If you put down less than 20% on a new car, you are starting out upside down from day one. You need gap. Second, you financed for a long term. 60 months used to be long. Now 72 and even 84-month loans are common. The longer the loan, the more slowly you build equity, and the longer you'll be upside down. If you have one of these long-term loans, you need gap. Third, you rolled negative equity from a previous trade-in into your new loan. This is a massive red flag. It means you were already upside down on your last car, and you just piled that old debt on top of your new debt. You are starting your new loan deeply underwater. In this case, gap insurance isn't just a good idea. It's an absolute necessity. And finally, if you bought a car that depreciates quickly, or if you drive a ton of miles which accelerates depreciation, gap is a very smart move. So who doesn't need it? If you put down 20% or more, you probably don't need it. Your large down payment creates an instant equity cushion. If you have a short loan term, say 48 months or less, you'll pay it off fast enough that the period you're upside down will be very brief, if at all. And of course, if you pay cash for your car, you have no loan, so there's no gap to insure. Okay, so let's say you need it. Where do you get it? This is where people make a huge, expensive mistake. When you're at the dealership, sitting in that little office with the finance manager, they will almost always offer you gap insurance. They'll present it as a simple, convenient add-on that they can just roll right into your car loan. Sounds easy, but it's often a terrible deal. Dealerships can mark up the price of gap insurance significantly. You might pay $500, $600, even $700 or more for a policy that they bought for half that. And because they roll it into your loan, you're not just paying that inflated price, you're paying interest on it for the entire life of the loan. You're paying interest on an insurance product. It's one of the worst financial moves you can make when buying a car. The smarter way? Call your own car insurance agent before you even sign the papers at the dealership. Almost every major insurance carrier offers gap coverage as an add-on to your existing policy, and it is almost always dramatically cheaper. We're talking maybe $5 or $6 a month. Over the course of a few years, that's a fraction of what the dealership charges, and you're not paying loan interest on it. So rule number 1, always check with your own insurer first. You can also sometimes get it from the credit union or bank that is financing your loan, often for a more reasonable flat fee than the dealership. Now for the pro tip that can save you real money, something most people forget. Gap insurance is not a set-it-and-forget-it product. You only need it as long as you are upside down on your loan. Remember that race between your car's value and your loan balance? Eventually, your loan balance will win. After a few years of payments, you'll owe less on the car than it's actually worth. At that point, you have equity. You are no longer upside down. And you are paying for gap insurance that you no longer need. Can literally do nothing for you at this point. So once or twice a year, do a simple 2-minute check. Go to a website like Kelley Blue Book or Edmunds and get a realistic private party value for your car. Then, look at your most recent loan statement and see your current payoff amount. The moment your car's value is higher than your loan payoff, it's time to make a call. Call your insurance provider and cancel the gap coverage. It might only save you $5 or $6 a month, but why throw that money away? If you bought it from the dealership, you can often cancel it and get a prorated refund for the unused portion, but it's a bit more of a hassle. So to recap, collision and comprehensive coverages pay the actual cash value of your car if it's totaled. But because of depreciation, that value can be less than what you still owe on your loan. That dangerous difference is the gap. And gap insurance is the specific tool designed to pay off that difference, protecting you from a devastating financial trap. It's crucial if you have a small down payment or a long-term loan, but you should buy it from your insurer, not the dealership, and you must remember to cancel it once you have equity. Mastering this concept is key to protecting yourself. Your collision coverage fixes your car. Your gap coverage fixes your loan. But we've only been talking about your stuff. What happens when the crash is your fault, and you've damaged someone else's property? What if you didn't just total your 10-year-old Honda, but you also plowed into a brand new Porsche? Who pays for that? That's where the most critical, most legally required, and financially significant part of your entire insurance policy comes into play. It's the coverage that protects you from lawsuits and financial ruin, and we're breaking down exactly how it works next. This is liability coverage, and it has absolutely nothing to do with fixing your car or paying for your medical bills. Its sole purpose is to pay for the damage and injuries you cause to other people. It's a shield. It stands between a bad day on the road and losing everything you own. Your house, your savings, your future income. It's all on the line in a serious at-fault accident. Liability coverage is what protects it. It's broken down into 2 simple parts. First, there's bodily injury liability, or BI. If you cause a crash that hurts someone, the other driver, their passengers, a pedestrian, this is the part of your policy that pays for their medical expenses, their lost wages if they can't work, and even for their pain and suffering. Again, this is exclusively for the people you injure, not for you or your own passengers. Second, there's property damage liability, or PD. This one's more straightforward. It pays to repair or replace whatever property you damage. Most of the time, that's the other person's car. But it could be a mailbox you run over, a fence you crash through, or even the wall of a building. If you damage someone else's stuff with your car, this is what pays for it. Now, here's where it gets confusing, and where so many people make a life-altering mistake. On your insurance policy, you don't just see liability coverage. You see a series of numbers, something like 50/100/50, or 100/300/100, or maybe something much lower. This isn't a random code. This is the absolute maximum amount of money your insurance company will pay out on your behalf. Understanding these three numbers is the single most important thing you can learn about your car insurance. Let's break it down using a common example. 50/100/50. The first number, 50, stands for $50,000. This is the maximum amount your bodily injury liability will pay for any one single person's injuries in an accident you cause. If you hit a car and the driver has $30,000 in medical bills, you're covered. If they have $60,000 in medical bills, your insurance pays the first $50,000, and we'll get to what happens to you in a minute. The second number, 100, stands for $100,000. This is the maximum amount your bodily injury liability will pay for all injuries combined in a single accident, no matter how many people are hurt. If you cause a crash that injures 4 people, your insurance company will not pay more than a total of $100,000 to be split among all of them, and no single one of them can get more than the $50,000 per person limit we just talked about. The third number, 50, stands for $50,000. This is your property damage liability limit. It's the absolute most your policy will pay to fix or replace any property you destroy in one accident. To see how this works in the real world, let's imagine 2 scenarios. Meet Sarah. She's a responsible driver with a good job and some savings. She has that 50/100/50 liability coverage. One rainy afternoon, she glances at her phone, misses a stop sign, and T-bones a minivan. It's clearly her fault. The minivan has a family of 3 inside. In scenario 1, it's a bad accident but not a catastrophe. The driver of the minivan breaks his arm and has $25,000 in medical bills. His wife has whiplash and incurs $10,000 in costs. Their son in the back is shaken up but okay, with $5,000 in checkup fees. The total medical cost is $40,000. Sarah's 50/100/50 policy handles this easily. No single person was over the $50,000 limit, and the total of $40,000 is well under the $100,000 per accident limit. The minivan is heavily damaged, with repair costs of $22,000. Sarah's $50,000 property damage limit covers that with room to spare. Sarah pays her deductible for her own car's repairs, her rates go up but her life goes on. Her savings, her home, her future are all safe. This is the system working as intended. But let's rewind to that same rainy afternoon. Same driver, Sarah. Same 50/100/50 policy. Same mistake. But this time the vehicle she hits isn't a simple minivan. It's a brand new Mercedes G-Wagon. And the driver isn't just anyone. He's a neurosurgeon. The surgeon suffers a severe back injury requiring surgery and extensive physical therapy. His medical bills total $90,000. Sarah's insurance looks at her policy. The per-person limit is $50,000. So the insurance company writes a check for $50,000 and not a penny more. The surgeon's lawyer immediately files a lawsuit against Sarah, personally, for the remaining $40,000 in medical bills. But it gets so much worse. The surgeon's injuries mean he can't perform surgery for 9 months. His lost income during that time is $400,000. This devastating loss is covered under bodily injury liability. Sarah's policy has a $100,000 total limit per accident. The policy has already paid $50,000 for the surgeon's medical bills. That means there's only $50,000 left in the entire bodily injury fund for this accident. The insurance company pays that remaining $50,000 toward his lost income. The surgeon is now suing Sarah personally for the remaining $350,000 in lost wages, plus the $40,000 in unpaid medical bills. We're not done. The G-Wagon? It's totaled. The replacement cost is $160,000. Sarah looks at her policy. The third number, her property damage limit, is $50,000. Her insurance pays the $50,000. The surgeon's insurance company and his lawyers then come after Sarah personally for the remaining $110,000. Let's add it up. Sarah is now personally on the hook for $40,000 in medical bills, $350,000 in lost wages, and $110,000 for the vehicle. In the space of a 2-second glance at her phone, Sarah has racked up a personal debt of $500,000. This is what financial ruin looks like. That $500,000 debt doesn't just go away. It leads to court judgments. They will garnish her wages, taking a percentage of every paycheck she ever earns. They will put a lien on her house. They will seize her savings accounts, her investments, any non-essential assets she owns. Her entire financial life, everything she has worked for and will ever work for, is now forfeit because of one mistake in a piece of paper that didn't have high enough numbers on it. And here's the most terrifying part. Millions of Americans are driving right now with coverage that is far, far worse than Sarah's. Every state has a legally required minimum amount of liability insurance you have to carry. In some states, that minimum is as low as 25/50/10. That's $10,000 for property damage. Think about that. The average price of a new car in America is now over $48,000. If you have a state minimum policy and you total an average new car, you could be on the hook for $38,000 before you even begin to talk about injuries. Carrying state minimum insurance is like trying to face a hurricane with a cocktail umbrella. It's legally compliant, but functionally useless in a serious crash. So when you choose your liability limits, you are not just buying car insurance. You are buying asset protection insurance. You need to ask yourself, what do I have to lose? Do you own a home? Do you have a retirement account? Do you have a decent income? You need to choose limits that are high enough to put a protective wall around all of those things. Because the other driver's lawyer isn't going to look at your insurance limits. They're going to look at your assets and your future earnings and take every last dime. So you followed this advice. You've shielded your entire financial future from lawsuits by getting high liability limits. You are protected from the other driver. But in that accident, your own car was destroyed. You broke your leg and have your own mountain of medical bills piling up. And liability coverage, the most important part of your policy, won't pay a single cent for any of it. So what does? How do you fix your own car and pay for your own injuries? That's where the other half of your policy kicks in, and it's what we're covering next. This half of your policy is the part that's all about you. It's the selfish part, and that's a good thing. While liability coverage is a shield to protect you from the rest of the world, these coverages are a safety net to catch you when you fall. They are designed to fix your car and patch you up, often regardless of who or what is to blame. Let's start with the biggest one, the one that protects the second most expensive thing you probably own, your car. The two main coverages that protect your vehicle are called collision and comprehensive. People mix them up all the time, but the difference is actually pretty simple. Collision coverage does exactly what it sounds like. It pays to repair or replace your car if it's damaged in a collision with another object, or if it overturns. The key here is the word collision. This could be hitting another car, of course, but it also means you back into a telephone pole, you scrape a parking garage pillar, you hit a massive pothole that wrecks your axle, or you swerve to miss a dog and end up in a ditch. In all these cases, you collided with something. And here is the most important thing to understand about collision coverage. It pays out regardless of who is at fault. If you cause the accident, it pays. If someone else causes the accident and they don't have insurance, it pays. If a hit-and-run driver smashes your car in a parking lot and vanishes, it pays. It is your personal safety net for your vehicle. But there's a catch. It's called a deductible. The deductible is the amount of money you have to pay out of your own pocket for a repair before your insurance company starts paying. Think of it like a copay for your car. Let's say you have a $500 deductible. You get into a fender bender, and the repair shop says it'll cost $3,000 to fix your car. You pay the first $500 directly to the shop, and your insurance company pays the remaining $2,500. If the damage was only $400, you just pay it yourself because it's less than your deductible. You wouldn't even file a claim. You get to choose your deductible amount when you buy your policy. Common choices are $250, $500, or $1,000. And here's the trade-off. A higher deductible means you're taking on more risk yourself, so the insurance company rewards you with a lower premium. A lower deductible means the insurance company is on the hook for more, so they charge you a higher premium. It's a balance between what you pay every month versus what you'd have to pay in an emergency. Now, if you own your car outright, it's all paid off, collision coverage is technically optional. But if you have a loan or a lease on your car, forget about it. Your lender will absolutely require you to have collision coverage. Why? Because until you pay off that loan, the car isn't just your asset, it's also their asset. They need to make sure their investment is protected if you wreck it. So, collision covers you when you hit something. But what about all the other bad things that can happen to a car? What about an act of God? A hailstorm that turns your car's hood into the surface of a golf ball. A deer that materializes out of the darkness on a country road and slams into your front end. What about crime? A thief who smashes your window to steal your laptop. A vandal who decides to key your driver's side door. What about just plain bad luck? A tree branch that cracks and falls on your roof during a storm. a flash flood that turns your street into a river. None of these are a collision in the traditional sense. And that is where comprehensive coverage comes in. Its official name is actually other than collision coverage, which is a perfect description. It covers theft, vandalism, fire, floods, hail, wind, hitting an animal and falling objects. It's the weird stuff policy. Just like collision, it also has a deductible that you choose and have to pay before the insurance kicks in. And just like collision, your lender will require you to have it if you have a loan or lease. Together, collision and comprehensive are often called full coverage. When you hear that term, this is what people mean: a policy that not only has liability to protect you from others, but also has collision and comprehensive to protect your own car. Okay, so your car is fixed. But what about you? What about your passengers? A twisted bumper is one thing. A twisted ankle or a broken arm is a whole different level of problem. Your regular health insurance will obviously play a big role here. But car insurance has its own specific coverages designed to handle the immediate medical aftermath of a crash. The first is called medical payments coverage, or MedPay for short. MedPay is straightforward. It pays for medical and funeral expenses for you and any passengers in your car who are injured in an accident, again, regardless of who is at fault. It covers things like health insurance deductibles and copays, ambulance rides, doctor visits, surgery, x-rays, and dental work if you injured your teeth. The beauty of MedPay is its speed. Determining who was at fault in an accident can take weeks or even months. You can't wait that long to pay the hospital. MedPay pays your bills right away, without waiting for the fault investigation to conclude. It's typically sold with limits per person, like $1,000, $5,000, or $10,000. So if you have $5,000 in MedPay, it will pay up to that amount for each injured person in your vehicle. It's relatively inexpensive to add, and it acts as a fantastic, fast-acting primary or secondary layer of medical protection. But there's an even more powerful version of this, required in about a dozen states. It's called Personal Injury Protection, or PIP. PIP is the cornerstone of what's known as a no-fault insurance system. In no-fault states, the law says that after an accident, each person's own car insurance pays for their own injuries, up to a certain limit, no matter who caused the crash. The goal is to get people their money for medical bills fast and to keep smaller injury claims out of the court system. PIP does everything MedPay does, covering hospital bills and doctor visits. But it goes so much further. The two superpowers of PIP are covering lost wages and essential services. Think about that. Lost wages. Imagine you're in a serious crash and you can't work for 3 months. Your medical bills might be covered by health insurance, but who's going to pay your mortgage? Who's going to buy your groceries? Your income has vanished. If you have PIP, it can actually reimburse you for a percentage of the income you lost while you were recovering. This is a monumental benefit that can be the difference between staying afloat and financial ruin after a bad accident. Then there are essential services. Let's say you're a single parent and you break your leg in a crash. You can't drive your kids to school, you can't do the laundry, you can't clean the house. PIP can help pay for services to get that stuff done for you, like hiring a cleaning service or paying for childcare you wouldn't have otherwise needed. PIP is a broader, more robust safety net designed to cover not just your medical bills, but the real-life economic fallout of being injured. In states where it's mandatory, you'll have to buy a certain minimum amount. In other states, it might be offered as an optional upgrade to MedPay. So let's put it all together. Liability coverage protects your wallet from the people you might injure. And this second set of coverages, collision, comprehensive, MedPay, and PIP, are there to repair your property and your body. They are the coverages that take care of you. You're now covered if you hit someone, and you're covered if you get hit. Your car can be fixed, your medical bills can be paid. You seem to be protected from every angle. But there's a terrifying gap we haven't talked about. A multi-trillion-dollar hole in this safety net. What happens when the person who hits you has terrible insurance? Or worse, no insurance at all? Suddenly, their problem becomes your massive financial nightmare. How do you protect yourself from the millions of uninsured drivers on the road? That's what we'll uncover next. This is the scenario that keeps responsible drivers up at night. You do everything right. You buy a safe car. You pay your insurance premium on time every month. You signal your turns, you stop at red lights, you don't text and drive. And then one day, waiting at a stoplight, you hear the screech of tires and feel a violent metallic crunch. Someone has just plowed into your back bumper. You're shaken, your neck hurts, and your car is a wreck. But the real nightmare is just beginning. The other driver gets out, apologetic, But then they utter the 6 words that can detonate your financial life. "I'm so sorry. I don't have insurance." In that moment, a sickening realization washes over you. Who is going to pay for this? Who covers the thousands of dollars to fix your car? Who pays for your emergency room visit, the MRI on your neck, the physical therapy you'll need for the next 6 months? Who covers the wages you lose because you can't work? The at-fault driver certainly can't. If they couldn't afford a basic insurance policy, they almost certainly don't have $50,000 sitting in a bank account to cover your damages. You can sue them, sure. You might even win a judgment. But winning a piece of paper that says they owe you money is a hollow victory when they have no money to give. You can't get blood from a stone. So the burden falls back on you. But wait, you think I have full coverage. Doesn't that cover me? Well, let's look at what we've learned. Your liability coverage? That only pays for damage you do to other people. Your collision coverage? That will fix your car, absolutely. But you'll have to pay your deductible first, $500, $1,000, maybe even $2,000 out of your own pocket for an accident that was 100% not your fault. And what about your injuries? Collision coverage does nothing for your medical bills. Your health insurance might help, but you'll still be on the hook for deductibles, copays, and co-insurance that can add up to thousands. And health insurance will never, ever pay you for your lost wages or for the pain and suffering you've endured. This is the gaping, terrifying hole in a standard insurance policy. It's a vulnerability that leaves you completely exposed to the irresponsibility of others. But there is a shield. There is a specific type of coverage designed for this exact nightmare scenario. It's called uninsured motorist coverage, or UM. Think of uninsured motorist coverage as your own insurance company stepping into the shoes of the driver who hit you. It's your financial bodyguard. When the at-fault driver has no insurance to pay for the damage they caused, your UM coverage kicks in and pays you instead. It's divided into 2 critical parts. First, and most importantly, is uninsured motorist bodily injury, or UMBI. This is the part that protects your health and your livelihood. If an uninsured driver injures you or your passengers, UMBI pays for your medical bills, from the ambulance ride to the surgery. It covers your follow-up appointments, your physical therapy, and your prescriptions. Crucially, it also covers your lost wages if you're unable to work. And it provides compensation for pain and suffering, something no health insurance policy will ever do. It makes you whole again when someone else's negligence tries to break you. Second is uninsured motorist property damage, or UMPD. This covers the repairs to your car. Now you might be thinking, but I already have collision coverage for that. And you're right. But here's the key difference. The deductible. Your collision deductible might be $1,000. When an uninsured driver hits you, your UMPD deductible is often much, much lower, typically around $250, and in some states it might be $0. It ensures you're not penalized with a high out-of-pocket cost for a crash you didn't cause. But the problem is actually bigger than just the people with no insurance. What about the people with bad insurance? The ones who buy the absolute cheapest bare-bones state minimum policy just to be legally on the road? This is where the situation gets even more common, and just as dangerous. Let's imagine a different crash. This time you're seriously injured. Your medical bills climb to $100,000, and you're out of work for months. The driver who hit you is clearly at fault. And good news, they have insurance. You breathe a sigh of relief. But then you discover their bodily injury liability limit is only $25,000. That's the legal minimum in many states. Their insurance company will cut you a check for $25,000 and that's it. They have fulfilled their legal obligation. They wash their hands of the situation. You're still left with $75,000 in medical bills, plus all your lost income, and the at-fault driver has no more assets to give. You are financially ruined even though the other driver had insurance. This is where the second part of this shield comes into play. Underinsured motorist coverage, or UIM. Underinsured motorist coverage is the hero that picks up where the other driver's pathetic policy leaves off. It bridges the gap between their low coverage limit and the actual cost of your injuries. In our example, after you receive the $25,000 from the at-fault driver's insurance, you would then file a claim with your own insurance company under your UIM coverage. Your UIM policy would then pay the remaining $75,000, up to the limits you selected for yourself. It's a safety net for your safety net. In most states, uninsured and underinsured motorist coverages are bundled together, often written as UM/UIM. And here's the most important thing to understand. The limits on your UM/UIM coverage should, ideally, Match the limits on your own bodily injury liability coverage. If you think you need $250,000 of liability coverage to protect your assets if you hurt someone else, then you should have that same $250,000 of UM/UIM coverage to protect yourself if someone else hurts you. You are, in effect, buying the insurance for the other guy that you hope he bought for himself. You are guaranteeing that you have access to the same level of financial protection that you provide to others. You might be wondering if this is really necessary. Is it worth the extra cost? Let me give you some perspective. The Insurance Research Council estimates that about 1 in every 8 drivers in the United States is uninsured. That's over 30 million vehicles on the road with no coverage. In some states like Mississippi, Florida, and New Mexico, that number jumps to 1 in 4. Every time you get behind the wheel, you are rolling the dice, sharing the road with millions of people who represent a direct threat to your financial security. And it gets worse. What about a hit and run? A driver slams into your car and speeds off into the night. You didn't get a license plate. There's no one to hold accountable. In the eyes of your insurance company, a phantom vehicle in a hit and run is treated as an uninsured motorist. In this terrifying situation, your UM/UIM coverage is your only hope. It's the only policy that will respond to cover your injuries, and depending on your state, the damage to your car. Without it, you are left completely alone to pick up the pieces. For just a few extra dollars a month, UM/UIM coverage is arguably the best value in all of insurance. It is the only coverage that protects you from the financial fallout of someone else's worst decision. It is the armor that shields your savings, your home, and your family's future from a threat you can't control. And there's one more powerful, advanced feature you should know about, if it's available in your state. It's called stacking. If you have multiple vehicles on your policy, stacking allows you to combine, or stack, the UM/UIM coverage limits from each vehicle. For example, let's say you have 2 cars, and you've chosen $100,000 of UM/UIM coverage on each. If you have stacked coverage, and you are seriously injured in an accident with an uninsured driver, you can combine those limits, giving you a total of $200,000 in available coverage. With unstacked coverage, you would only be able to access the $100,000 limit of the single car involved in the crash. Stacking costs a little more, but it is an incredible way to multiply your protection for a very small price. Ultimately, you can't control if the person texting in the car next to you has insurance. You can't control if they bought a policy that's barely legal, but you can control your own policy. You can choose to build a fortress around your finances, so you're protected from the big financial hits. Your medical bills are covered, your car can be repaired, but you're stranded on the side of the highway. Your car is in the shop for 2 weeks and you still have to get to work. How do you pay for a tow truck? A rental car? These small expenses can add up to thousands of dollars fast. Is there a way to make sure you're not out of pocket for these crippling inconveniences? Yes, there is, and it's probably cheaper than you think. These are often called endorsements or riders, which are just fancy insurance words for add-ons. They're like the a la carte menu of your policy, allowing you to customize your protection for your specific life. Let's start with the most common one, the one that solves the problem of being stranded on the side of a highway at midnight. Roadside assistance and towing. For a few extra dollars a month, sometimes literally the price of a single cup of coffee, this coverage is your lifeline. Get a flat tire? They'll send someone to change it. Lock your keys in the car? They'll send a locksmith. Run out of gas? They'll bring you a few gallons. Dead battery? You get a jump start. And the big one. If your car is undrivable after a crash, they will cover the cost of a tow truck to take it to a repair shop or your home. Think about the last time you saw a tow truck on the highway. That service isn't cheap. A single tow can easily cost $100, $200, even $500 or more depending on the distance and the situation. But with this coverage, you just make a phone call. No frantic searching for a towing company. No haggling over prices while you're shaken up from an accident. You call the number on your insurance card, and help is on its way. For the incredibly low cost, this is one of the most valuable no-brainer add-ons you can get. It buys you convenience and, more importantly, peace of mind in a stressful situation. Okay, so your car is off the road and at the shop. Now for the second crippling inconvenience. How do you get to work tomorrow? How do you take your kids to school? This is where rental reimbursement coverage comes in. This isn't about renting a convertible for a fun weekend. This is about maintaining your life while your primary mode of transportation is out of commission. Here's how it works. If your car is in the shop for a covered repair, meaning the damage was from an accident that your policy covers. This add-on will pay for a rental car. Now, it's not a blank check. Your policy will have specific limits. A common one might be something like $30 a day for a maximum of 30 days. This means the insurance company will pay up to $30 of your daily rental fee, and they'll do it for up to a month. You might be thinking, $30 a day? That won't even get me a compact car. And you might be right depending on where you live. That's why you can usually choose your limits. You can opt for $40, $50, or even $60 a day. The higher the limit, the slightly more you'll pay for the coverage, but it's usually a very small increase. Let's do the math. Imagine a moderately serious accident. The body shop is backed up, and they tell you it'll be 3 weeks before you get your car back. That's 21 days. If a basic rental costs $50 a day, you are looking at a bill of $1,050. Out of your own pocket. That's a mortgage payment for some people. That's a vacation you don't get to take. But if you had rental reimbursement coverage that you were paying, say, $5 extra for each month, your insurance company would cover that cost up to your policy limit. You just keep living your life. It transforms a potential financial disaster into a minor inconvenience. Now let's talk about the big one. The one that can financially ruin people who buy new cars. It's called gap insurance. And to understand it, you need to understand the single most brutal financial reality of owning a car: depreciation. The second you drive a brand new car off the dealer's lot, it loses value. Thousands of dollars gone in an instant. After 1 year, your new car could be worth 20% less than what you paid for it. Here's the nightmare scenario. You buy a beautiful new SUV for $40,000. You make a small down payment and finance the rest. A year and a half later, you get into a major accident, and the car is declared a total loss. It's totaled. At this point, because of depreciation, the actual cash value of your SUV, what it's worth on the open market, is only $28,000. That's the most your collision coverage will pay you. But you look at your auto loan statement, and you still owe the bank $34,000. Do you see the problem? The insurance company gives you a check for $28,000. You hand that entire check over to the bank, and you still owe the bank $6,000. You are now $6,000 in debt, making monthly payments on a vehicle that is a twisted pile of metal in a junkyard. You have no car and you have a massive bill. This is the gap. The gap between what your car is worth and what you still owe on your loan. This is exactly what gap insurance is for. It is designed to pay off that difference. In our scenario, gap insurance would write a check for that $6,000, clearing your debt with the bank. It saves you from a financial catastrophe. So, who needs gap insurance? You absolutely should consider it if you made a small down payment or no down payment at all. If you financed your car for a long term like 60, 72, or even 84 months. Or if you bought a car that is known to depreciate quickly. Dealerships will often try to sell you this, but you can almost always get it cheaper by adding it directly to your auto insurance policy. Check both prices, but don't ignore it. It's a shield against the devastating power of depreciation. Now there's a premium version of this concept, a step above gap insurance. It's called new car replacement coverage, where gap insurance just pays off your loan, leaving you at zero. New car replacement goes much further. If your new car is totaled within the first year or two of ownership, the exact terms depend on the policy. This coverage won't just give you the depreciated actual cash value. It will give you enough money to buy a brand new car of the same make and model at today's price. Let's go back to that $40,000 SUV. It gets totaled a year later when it's only worth $28,000. If you have new car replacement, your insurance company doesn't give you $28,000. They cut you a check for $40,000 or whatever the cost is to buy this year's model, so you can go right back to the dealership and get a brand new one, effectively erasing the depreciation you suffered. It's more expensive than gap insurance for sure, but for those who want to completely protect their new car investment, it offers the ultimate peace of mind. These are the big three add-ons, but there are others. Do you have expensive custom rims, a high-end stereo system, or a custom paint job? Standard policies won't cover those. You need custom parts and equipment coverage. This ensures that if your car is damaged or stolen, you'll be compensated for those expensive upgrades you've invested in. Do you drive for Uber or Lyft? Your personal auto policy almost certainly does not cover you while you're working. There's a gap between when your personal policy is active and when the rideshare company's insurance kicks in. Rideshare coverage fills that specific gap, protecting you during the time you're logged into the app and waiting for a ride request. Each of these coverages is a tool. a tool you can use to build a policy that fits your life like a glove. They plug the holes that a standard policy leaves open, protecting you not just from the crash itself, but from the cascade of expensive, frustrating problems that follow. They turn a potential life-altering disaster into a manageable problem. So now you understand the core coverages, the deductibles, the limits, and the crucial add-ons that can save you from financial ruin. You have all the pieces of the puzzle, but knowing what the pieces are is one thing. Assembling them into the perfect picture at the lowest possible price is another game entirely. How do you take all this knowledge and actually use it to save money? How do you negotiate with insurance companies? And what is the single biggest mistake people make that costs them thousands, a mistake you might be about to make yourself? We're going to pull back the curtain on the industry secrets to getting the absolute best deal on the perfect policy. The single biggest mistake is also the most common. It's the silent, passive error that millions of drivers make every single year. Letting your policy auto-renew without shopping around. Feels easy, feels safe, feels like you're being rewarded for loyalty. But in the world of insurance, loyalty is often punished, not rewarded. This mistake isn't just leaving a few dollars on the table. It's practically handing over a blank check to your insurer. Here's the first secret the industry doesn't advertise. There's a right time to shop for insurance, and it's not the day before your policy expires. The sweet spot is typically between 20 and 40 days before your renewal date. Why? Because insurance companies have mountains of data, and that data tells them that people who shop for insurance at the last minute are statistically riskier. They might be more impulsive, less organized, or in a desperate situation because their previous policy was canceled. By shopping early, you signal to them that you are a responsible, forward-thinking customer, the exact kind they want to attract with their best rates. Waiting until the last week can literally cost you hundreds of dollars for the exact same coverage. Now, let's talk about that loyalty punishment I mentioned. It has a name in the industry: price optimization. It sounds harmless, but it's a dagger in your wallet. Price optimization is the practice of using sophisticated data analysis to figure out the absolute maximum amount they can raise your premium before you reach your breaking point and actually leave. They know how long you've been a customer, whether you've ever shopped around, and even your online browsing habits. They use this to predict your personal price sensitivity. So that small 5% increase this year, and another 6% next year, it may have nothing to do with your driving record or rising costs. It might just be them turning the dial, testing how much you're willing to pay for the convenience of doing nothing. Your loyalty isn't earning you a discount. It's putting a target on your back for incremental price hikes they know you probably won't notice. This is why the most powerful weapon in your arsenal is comparison shopping. And I don't mean getting one other quote. I mean a full-on market assault. To do this right, you need to understand the three main types of insurance providers. First, you have the direct writers like Geico and Progressive. You deal with them directly online or over the phone. They often have competitive rates because they cut out the middleman. Second, you have captive agents, who work for a single company like State Farm or Allstate. They can provide personalized service and deep knowledge of their one company's products. Third, you have independent agents or brokers. These are the secret weapon. They work for you, not an insurance company. They can pull quotes from dozens of different carriers, including some you've never even heard of, to find the absolute best fit for your specific situation. Your strategy should be to get quotes from all three. Go online and get a quote from a major direct writer. Call a captive agent from a big-name brand. And most importantly, find a well-regarded independent agent in your area. When you do this, you must ensure you are comparing apples to apples. Use your current policy's declaration page as a cheat sheet. Make sure every quote has the exact same liability limits, the same deductibles for collision and comprehensive, and the same add-ons like rental car reimbursement or roadside assistance. Only then can you see who is truly offering the best price. Once you have the quotes, it's time to dig for treasure with secret number 4. Discount stacking. Insurers have a menu of discounts, and most people only know the basic ones. You need to become a discount detective. Yes, bundle your auto and home or renter's insurance. That's the biggest and easiest one. But did you ask about an affiliation discount? Many companies offer savings if you're a member of a certain alumni association, a professional organization, a credit union, or even work for a specific large employer. Did you take a defensive driving course? In many states, that's an easy 5 to 10% off for 3 years. Are you driving less because you work from home? Don't just hope they notice. Call them and ask for a low mileage discount. And then there's the big one, telematics. or usage-based insurance. This is where you let the insurance company monitor your driving through a smartphone app or a small device you plug into your car. It tracks things like hard braking, rapid acceleration, late-night driving, and phone use. Now, this comes with a major privacy trade-off, and it's not for everyone. But if you are a genuinely safe, conservative driver, it can unlock savings of up to 30 or even 40%. You are proving to them in real time that you are a low risk, and they will reward you for it. But perhaps the most shocking secret of all is the enormous impact of your credit score. In every state except California, Hawaii, Massachusetts, and Michigan, your credit-based insurance score is one of the most significant factors in determining your premium. Insurers have data that shows a statistical correlation between how a person manages their finances and how likely they are to file a claim. It feels unfair, but it's the reality of the system. A person with poor credit can pay twice as much or even more for the exact same coverage as someone with excellent credit, even if they have a perfect driving record. So what do? Before you even start shopping for insurance, get a copy of your credit report. It's free. Check it for any errors or inaccuracies and dispute them immediately. Even a small correction can bump up your score and save you a fortune. Work on paying your bills on time and keeping your credit card balances low. Improving your financial health has the direct, immediate benefit of lowering your insurance costs. So let's put it all together. Here is your 4-step battle plan to getting the perfect policy at the best possible price. Step 1. Know your battlefield. Before you do anything, review your current policy. Do you still need that $100 deductible on your 10-year-old car? Are your liability limits high enough to protect your assets now that you've gotten a raise? Adjust your desired coverages to fit your current life, not the life you had a year ago. Step 2. Prepare your weapons. Pull your credit report and clean up any errors. Make a list of every possible discount you could qualify for: your job, your alumni group, that defensive driving course you took 2 years ago. Step 3. Launch the attack. Set aside 1 hour. In that hour, get an online quote from a direct writer, call a captive agent, and email an independent agent. Give all of them the exact same coverage requirements. Now sit back and let the offers roll in. Step 4. The final move. Once you have the best quote in hand, make one last call to your current insurance company. Be polite but firm. Say, "I've been a loyal customer for X years. I have a quote here from another company for the same coverage that will save me X $100 a year. I would prefer to stay with you, but I need you to match this rate." Sometimes they'll say no, but you'd be shocked how often they suddenly find a new discount or a special credit to keep you from walking out the door. This isn't just about saving a few bucks. This is about taking back control from an industry that counts on your inertia. The knowledge you've gained through this entire series, understanding what liability really protects, how deductibles work, what to do after a crash, and now how to strategically shop, has transformed you from a passive consumer into an empowered expert of your own policy. You now know how the game is played. The simple act of spending an hour on this once a year is one of the highest paying jobs you'll ever have. You are no longer just a driver. You are the savvy financial manager of your life on the road. Now go get the deal you deserve.